Welcome to the Debt Dilemma: Crush Loans or Compound Wealth. Today we will unpack how to balance paying down debt with investing for the future. We will combine proven principles, real-world trade-offs, and practical steps so you can create a plan that fits your risk tolerance and interest rates. To begin, let's preview what we'll cover so you always know where we are headed. Here is the agenda. First, we will frame the core decision between paying down debt and investing. Next, we will lock in two essential moves: building an emergency fund and capturing any employer retirement match. Then, we will discuss the guaranteed return from paying down high-interest loans and the power of compounding through early investing. After that, we will reveal a hybrid plan and walk through practical steps and examples. Finally, we will test your knowledge with a quick quiz. Now, before we dive in, we need a short but important disclaimer. This video is for educational purposes only and is not financial, legal, or tax advice. Your situation is unique, and interest rates, employer benefits, and risk tolerance vary widely. Please consult a licensed professional before making big financial decisions. With that covered, let's set the stage for the core decision you are facing. At the crossroads, you are weighing a guaranteed return from debt payoff against the long-term growth potential of investing. Paying down debt yields a return equal to the interest rate you avoid. Meanwhile, investing early leverages compounding, which can dramatically increase future wealth. The optimal decision blends both, guided by your loan rates and tolerance for risk. Next, let's lock in the safety-first priorities that come before aggressive debt payoff or investing. Start by building a 3 to 6 month emergency fund to handle job loss or unexpected expenses without taking on more debt. Then capture any employer retirement match, because it is effectively a 100% instant return on contributions up to the match limit. Automating both the emergency savings and the match contributions ensures consistency and reduces decision fatigue. With safety in place, we can evaluate the guaranteed return from paying down high-interest debt. Paying down a 6.3% loan yields a risk-free 6.3% return, which competes with many market expectations, especially during volatility. Therefore, prioritize debts with interest rates at or above 6%. Use the Avalanche Method by tackling the highest interest rate first while paying minimums on the rest. For lower-rate debts, it can make sense to continue making regular payments while also investing. Now, how do we structure a plan that balances both payoff and growth? Let's visualize a strategy map. This mind map centers on a balanced wealth strategy. The first branch is safety first, which includes building a 3 to 6 month emergency fund and capturing an employer match. The next branch addresses high-interest debt with Avalanche for any loans above 6%, potential refinancing, and automated payments. Investing early covers funded Roth IRAs or 401k contributions, preference for low-cost index funds, and a priority on tax-advantaged accounts. The hybrid allocation branch shows a sample split of 60% to debt, 25% to investing, and 15% to cash, with adjustments based on risk tolerance. Finally, Behavioral Wins emphasizes automation, using the snowball method for motivation if needed, and celebrating milestones. Next, let's examine how early investing compounds over time. Compounding is about time, not timing. Small contributions made in your 20s can snowball into significant balances because returns build on prior returns. Even if you are prioritizing high-interest debt, it often makes sense to invest a smaller, consistent amount in tax-advantaged accounts so you do not lose early years of compounding. Delaying contributions can be costly because you cannot recover lost time. Next, we will detail exactly how to run the Avalanche Method effectively. To run the Avalanche Method, list every debt, including balances, minimum payments, and interest rates. Pay at least the minimum on all accounts to stay current. Direct all extra dollars to the highest interest rate debt first. After that debt is eliminated, roll the entire freed payment to the next highest rate. This approach minimizes total interest paid and often finishes faster than random or equal payments. Now, let's turn the framework into step-by-step actions you can implement this month. Follow this 7-step plan. First, track cash flow and automate bills. Second, build a 3 to 6 month emergency fund in a high-yield savings account. Third, contribute enough to capture the full employer retirement match. Fourth, list all debts with balances, minimum payments, and APRs, and note whether the rates are fixed or variable. Fifth, Attack debts with interest rates at or above 6% using the Avalanche Method. Sixth, invest a smaller, steady amount into tax-advantaged accounts, such as a Roth IRA or 401k. Seventh, once high-interest debt is eliminated, redirect those freed payments to increase your long-term investing. Next, we will compare Avalanche and Snowball so you can choose the best fit behaviorally. Avalanche minimizes total interest and is mathematically optimal when you keep payments constant, because it eliminates the most expensive debt first. Snowball focuses on motivation by quickly removing small balances to create psychological momentum. If you struggle to stay consistent, Snowball can help you stick with the plan, which can matter more than theoretical optimality. If you are disciplined, Avalanche will usually save more money and time. Now, to ground the plan in numbers, let's review scenarios and allocations. This table provides sample strategies. With high rates at 7% or more, emphasize aggressive payoff, perhaps allocating 70% to debt, 20% to investing, and 10% to cash. With a mixed profile, including one loan around 6 to 7% and others at 3 to 5%, use a hybrid split such as 60% to debt, 25% to investing, and 15% to cash. With low-rate debts at 4% or less, you can tilt more toward investing while maintaining steady debt payments. Next, we will check your understanding with a quick quiz. Quiz time. Which action should generally come first before accelerating any debt payoff or investing beyond the basics? Option A, max out a Roth IRA. Option B, build a 3 to 6 month emergency fund and capture the employer match. Option C, pay off the lowest balance first. Option D, buy individual stocks for higher returns. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is B. Building a 3 to 6 month emergency fund and capturing the employer match should come before accelerating debt payoff or investing beyond the basics, because safety and guaranteed free returns form a strong foundation. Next, let's add a markdown cheat sheet you can screenshot for quick reference. Here is a markdown style cheat sheet. First, it reiterates the order of operations: emergency fund, employer match, Avalanche for rates at or above 6%, and then increased investing. Second, it shows quick math. Paying off a 6.3% loan equals a risk-free 6.3% return. A compounding snapshot illustrates that $200 per month at 7% for 35 years can grow to roughly $354,000, while delaying 10 years reduces that to about $163,000, implying a cost of approximately $191,000 from waiting. Third, it provides allocation templates for high, mixed, and low-interest scenarios. Next, let's sketch a simple action timeline using a Gantt chart. This Gantt chart lays out a 90-day action plan. In the first 30 days, focus on cash flow and safety, track spending, open a high-yield savings account, begin building the emergency fund, and capture the employer match. Over the next 30 days, create your debt strategy by listing all debts with APRs, automating minimum payments, and directing any extra funds to the highest APR using the Avalanche Method. During the final 30 days, set an auto-invest percentage, review your allocation split, and celebrate your first milestone to reinforce habits. Next, we will highlight the key takeaways you should remember. These are the key points. Put safety first with an emergency fund and employer match. Crush debts at or above 6% using the Avalanche approach. Invest early, even if only a small amount, so compounding works for you. Use a hybrid split that reflects your loan rates and personal risk tolerance. Finally, automate contributions and payments, and revisit your plan quarterly to adjust. Now let's summarize and close with your next steps. To wrap up, follow the sequence: safety, high-interest debt payoff, early investing, and then scale contributions after debts are cleared. Blending payoff and investing yields strong, balanced outcomes. Because time in the market is powerful, start now with small steps and automate the process. Finally, let's close with a thank you and a call to action. Thank you for watching. If this video helped, please like, share, and subscribe for more content on practical wealth building. In the comments, tell us whether you are Team Avalanche, Team Snowball, or Team Hybrid, and share your next financial milestone. Your story might inspire someone else to take action.